If you've been thinking of buying a home, you may have been watching what's happened with mortgage rates this past year. It's true, they've risen dramatically. But where are they going to go from here, and how will that affect your mortgage payment in 2023? As you think about your homeownership goals and try to make the decision as to whether or not now is the right time to make your move, the best place to start is with the professionals. Here is a summary of the latest mortgage rate forecast from industry experts. While mortgage rates continue to fluctuate due to inflationary pressures and economic uncertainty, industry experts are predicting that those rates are going to stabilize in the coming months. According to the latest projections, mortgage rates are expected to hover in the low 5% range and ultimately dip into the high 4% range towards the end of next year. As a buyer, that could bring you some much needed relief, as interest rates have climbed over 2% this year alone due to the Federal Reserve's response to inflation. And that has quite frankly made it more expensive to buy a home and has put a lot of buyers on the sidelines who aren't quite sure they can afford that mortgage. But now that industry experts are saying that mortgage rates are going to stabilize, that gives you, the buyer, a little bit of breathing room. What that does for you as a buyer is it gives you a little bit more certainty in what you think the future will hold. And that may make you feel more comfortable in your decision to buy a home. Now, let's talk about how these interest rates are going to affect your mortgage payment. We obviously know that the lower your interest rate, the lower your monthly mortgage payment, but what does that mean exactly? What I want you to think about is that for every 1% that interest rates go up, you as a buyer lose 10% of your buying power. When rates go up, you lose your buying power. What does that mean? So for example, if we're looking at a $300,000 house, a year or two ago at 3% may have been a mortgage payment of $1,500. Now, as rates have driven up to 5%, you have lost purchasing power, meaning if you still need your mortgage to be $1,500 a month, you're now looking $30,000 to $60,000 less than $300 because of the higher interest rate. So the really great news is that with rates starting to stabilize, you can start to make an informed decision, crunch the numbers, and buy the right house for you without worrying that rates are going to plummet or keep rising. Now is the time to act. Whether you're buying your first house, you're upsizing, you're downsizing, or investing, you need to know what's happening in the housing market so that you can make an informed decision. And something else that you should be informed about is whether or not it's right for you to purchase points from your lender to lower your interest rate. So if that's something that speaks to you, don't miss my video. I'm Lindsey Johnson, your resource for all things real estate. See you next time.